First-time buyers in the UK are in a desperate position to get on the housing ladder, and many have found that taking on longer loans is the only affordable way to own their home. Cases now, mortgages are being offered and taken with 35-year terms and even 40-year terms as well. And I was kind of shocked by this news, and talking to my husband, his first mortgage was 35 years too, but this was back in 2010, and that was when he was in his late 20s, so that would have pretty much taken him his entire working life to repay it if he kept it. But many of us are willing to give up our entire working lives and more to the mortgage lenders. That's pretty insane, right? Well, his plan was to make overpayments in order to pay it off early. That is madness as well. Delusion or what? So what's the sitch, guys? I've noticed that as a first-time buyer, we get bombarded with information that interest rates are so low and property prices are so high that longer-term mortgages are the only way to keep repayments affordable. The win for buyers is clear. Choosing a long-term deal means borrowers pay smaller installments on their mortgages each month, and so it makes it easier to manage. It's a popular tactic for first-time buyers who want to push their lending restrictions to the max and affordability as far as possible and borrow as much as possible. It's literally maximizing everything. Why is this even a problem though? Haha. Well, let's sprinkle the facts and find out. First of all, the number of 35-year mortgages has hit a 3-year high according to wealth manager Quilter, and the FCA noted that in March 2021 versus March 2020 the numbers were up by 75%. Now, you guys know how I feel about headlines like this. I mean, during a pandemic, numbers are massively distorted, so not gonna lie, I don't really take too much home from those stats. But even with that caveat, that rise in 35-year mortgages, house price increases and tax easing is all very interesting, because it points to some interesting theories of how the housing market is behaving. And annualized house price inflation for March 2021 was at over 10%, and coupled with supply problems, buyers are pushing themselves to the limit. So you can sense how frenzied the housing market has been, despite there being a global pandemic. But one thing I have been thinking about is cause and effect, which is rapidly rising house prices pushing first-time buyers out, and those that are on the margin going against the grain to take on bigger debt and pushing their affordability to reduce those monthly payments. What do I think about that then? Well, the normal mortgage duration used to be 25 years, but as house prices have increased, the market has evolved to 35 years. Now, if you are already a homeowner, this is kind of good, because these types of structural changes to the market are evolutions that would help support higher prices in general. However, on the flip side, the biggest risk is that you'll be paying these mortgages through your entire career. And imagine being old and wise and still paying these mortgages back. That's painful information and foresight. The scariest part for me is having to pay a mortgage after I have retired, because that really just gives me anxiety just thinking about it. We work our entire lives and remain indebted at the end of it. And what if we get older and we become less able to afford the repayment? You just don't know what the future holds. And one of the ways we rationalize it, and that's what my husband obviously did, is by the fact that the interest rates are so low. So there's no lie there, they are. It's a low interest rate on a really large amount, so we are paying a lot of money interest in absolute terms. It's kind of eye-watering. And yep, sure, historically house price expansion has comfortably offset the interest rates, but that's no guarantee at all. Let's look at a few examples. If we take a 250k mortgage as an example with 2% interest and a 25-year term, then the repayments will be about $1,060 a month and a total bill of $318k in the end. That would mean you would have paid a total of £68,000 in interest. That's a lot of money. But if you take that same loan and do it for more than 30 years, we pay £924 a month, so you've saved a bit on the monthly budget, and the total loan is $333k, so you're paying $80k over 35 years. So hear this now, if we have a 35-year loan, we pay £828 a month, but the total loan is $348,000, and then for 40 years the numbers just keep getting more and more ridiculous. So 25 years we pay $1,060 a month and 68k in interest, and for 40 years we pay £757 a month, but 114,000 in interest. That is 70% more interest. So that's a lot of interest, guys. Now, there is a popular rebuttal to taking on these long-term mortgages. The first, of course, is interest rates are so low. And that's like I've been saying, and I'm beginning to sound like a broken record, I know. But the second is what my husband thought about, which is making overpayments. There is a lot to be said about being young in our careers, and while our professional careers are long and we'll have plenty of bumps in the road, generally speaking, if we elect to be slaves to our careers, then our income goes up as we get older. And so we have the ability to overpay. So overpaying on your mortgage is important, especially where the mortgage term is so long. We need to have some plan and consideration which is targeted on how we think about that tenure of the mortgage itself. I don't have any data to back this up, but my gut kind of says that I think the stats on overpayment is probably lower than those that say that they intend to overpay, which is fine if you're investing instead of overpaying, but we probably aren't doing that either. Sorry, I am a cynic of my age, guys. At the end of the day, when you think about it, this is the new reality with long-term mortgages and high multiples. Halifax are now saying that you need 8.5 times your salary now for a mortgage, and that's the new normal. It's the only way to reassure a bank that we can afford the mortgage and afford to live as well. But with all that being said and done, this is just kicking the can down the road, and criticism would point to the UK having to improve housing supply, control house price inflation, and systemic changes to how home mortgages should work. It's what we all know. I suppose we're all just a bit too sensitive to do anything strongly about that because there are losers on both sides. Maybe a high inflation environment like the one we have now is perhaps one way of chipping away at house prices over the long term in real terms. But how do we fix the housing issue? Well, that bit, I don't know. It's not my specialty. But some lenders are interpreting this as evolving mortgage products in the UK, which still feel rather dated. So for instance, long-term fixed mortgages that can be fixed for 10, 20, or even 30 years with mechanisms to change products every 5 years. Products like that would help with reassurance for the long-term stability of the market. And one of the things I do get asked a lot is, should you even overpay on your mortgage? And this was quite a big issue I was grappling over about a year ago when I first started my channel. So here is a video from back then that explains what I think. I was a super newbie YouTuber back then, so excuse me for the ums and ahs. It is so cringe, but yeah, check it out if you fancy.